Is a private equity fund a pooled investment? What if I told you some of the best opportunities out there are not on the stock market? Private equity funds give you access to exclusive deals, but are they just pooled investment vehicles? Well, in this video, let's break it down. Most people think that private equity investments are only for billionaires or big institutions, but I'm going to show you that they're not. I'm going to show you how private equity funds work, why they're considered pool investments, and how you can get started investing in them. If you've ever wondered why investors pool their investments together into a private equity fund, I'll explain how it works, what you get as an investor, and how these funds generate such high returns. By the end of this video, you're going to understand what a private equity fund is, why it's considered a pooled investment vehicle, and how you can invest in one to generate long-term wealth. So what is a private equity fund? A private equity or PE fund is a professionally managed investment fund that pools capital from multiple investors to buy, grow, and sell private assets. So what are the type of investments? Private equity loves to buy businesses, leverage buyouts or buyouts of company, venture capital, and growth equity. Real estate, including multifamily, meaning apartments, office, industrial, retail, self-storage, mobile home communities, even car washes. Private debt, which are funds that focus on lending to private businesses or private real estate operators or projects. Why is a private equity fund a pooled investment vehicle? Well, this is how they work. Multiple investors, these are considered the LPs or limited partners, invest their capital into a fund. The fund manager, the general partner, oversees investments and decides how to deploy those pooled funds. So the limited partners or investors own a share of the fund instead of a piece of each individual asset. One of the keys to pooled investment funds is diversification. Investors own a share of the fund instead of direct ownership of one single asset. This is one of the strengths of pooled investment funds because investors get exposure to all the assets in the fund instead of just one single investment. How private equity funds work, step by step. Step 1, investors commit capital. Most funds require at least $50,000 investment, and many require a lot larger minimum investments. Some funds require all the investment up front during that commitment of the investment. Other funds require the commitment of investment and will call the capital over time as they need that capital to go deploy and buy more assets. Ask your fund administrator or sponsor if they're going to call the capital up front or if they're going to call the capital over time. Step 2. The fund starts accepting investment. They start raising the capital from the limited partners and pooling those funds together in the investment fund. Step 3, the fund manager goes out and identifies assets they're going to acquire, and they take over management, acquiring those assets, and start building and improving on the operational efficiencies. Step 4, the fund manager manages those assets over a 5 to 10 year period of time, driving value to those assets, improving the income, reducing the expenses, and making the operational efficiencies drive more value to the bottom line for the fund. During this time, investors should be receiving distributions, getting their fair share of profits. Many investment funds structure a preferred return model where the investor's capital gets a preferential return. Ours here at Patriot is 8%, but you'll see them range anywhere between 5 and 10% as a preferred return metric. This is calculated similar to interest on the initial investment. As distributions are paid from profits of the fund, this shouldn't pay down your capital account. This is in addition to your capital that you invested, and you get the first 8% preferred return on profits. An important question to ask the sponsor is there a catch-up provision in my investment structure? A catch-up provision means after the investors get their preferred return and after the assets are sold for a profit, as the assets are sold, the investment sponsor can then charge back all of those preferred return fees. They can charge those as a fee and receive those fees themselves as well. So this lowers the return for the limited partners, so keep a close eye out for the catch-up provision in any private equity fund investments. One other question to ask your investment sponsor is, when I make my investment, does my investment accrue my preferred return immediately? Meaning, does it start to generate that 8 or 9% preferred return? Or does it sit in an account where the investment sponsor doesn't start paying the preferred return until that money's deployed into an asset? It makes a big difference if they can't find any deals and your investment stays in an account where you're not generating any return on investment. Step 5, the fund period is over and the fund starts selling off all the assets. This is where the sponsor catches up or pays any preferred return, plus pays the limited partners their shares of the profits based on the waterfall split. A waterfall split in private equity means the distribution of profits. The way that works is you have capital that's invested, typically you have a preferred return, then you have return of capital, and then you have the profit sharing split, anywhere between 80-20, 80% going to the limited partners, 20% going to the general partners, down to a 50-50, where 50% goes to limited partners, 50% goes to the general partners. But only after the return of capital is paid back, the preferred return is paid, and the investor is then paid his profit sharing split. So be sure to check your fund docs or the partnership documents to know what type of partnership structure you're in on a private equity fund. So let me give you a private equity fund example. So here at Patriot Holdings, I'm on my 5th fund where we raised $25 million. It's a fixed fund, meaning we have a closed-in period of time. We raise the capital over a 12 to 18-month period of time. Then we go out and deploy it over that 12 to 24-month period of time using the pooled investment from investors to go buy assets. And then we buy typically 15, 16 assets in this pooled investment fund, and those investments start distributing profits or cash flow back into the fund. When it goes back into the fund, investors start getting their preferred return payments. This is that 8% preferred return on their capital invested. As we hold these assets, we raise rents. We like to invest in mobile home parks, self-storage facilities, and warehouses. As we're raising the rents and lowering the expenses due to our operational efficiencies, we're able to drive higher margins or higher profits on all those assets, and that makes the fund more profitable. As the fund's more profitable, then we're ready to sell off some of these assets at premium prices, meaning we added significant value to each one of the assets that we bought. Not only through raising rents and lowering expenses, but doing capital improvements, improving the roads, curbs, gutters, homes, lighting, fencing, anything that we can do to improve the curb appeal, signage, the customer service experience. This is how private equity works, and this is how at Patriot we drive value to those assets. Now the assets are at peak value. This is when we sell those assets. When we sell those assets, all the investors get paid back their preferred return that's accrued if we haven't been caught up over that period of time, paying them out of cash flow. Then they get their capital returned to them, and then they get their share 70% plus of the profits. That's a real case study of how a private equity fund that focuses on alternative investment works, and it's a pooled investment vehicle. Here's the pros and cons of investing in a private equity fund. Diversification, exposure to multiple assets instead of a single deal. Cons, illiquidity, capital's locked up for 5 to 10 years. Potential for higher returns. Private equity funds have often outperformed public markets. Cons, accreditation requirements. Some funds require accredited investor status. This is $1 million of net worth, excluding the equity in your home, or $200,000 salary over the last 2 years. Professional management. A pro is experienced teams can handle acquisitions and operations, and they're going to create value. Cons, some private equity firms charge excessive management fees and performance fees that will lower the overall return to the investor. Tax advantages. Pros, depreciation, capital gains deferrals, it's tax advantage returns in private equity real estate funds. Risk or cons, success depends solely on the fund manager's execution, track record, and experience. How to invest in a private equity fund, step by step. Step 1, determine what the minimum investment would be that you would want to put into a private equity fund. I would start with at least $50,000 because that is the minimum requirement for most funds. Number 2, look for experienced fund managers or strategies that meet your personal investing goals. Look for sponsors that have an alignment of interest where they're going to put capital with your capital in the investment. 2, they have a good track record. And 3, the timeline is reasonable that you are expecting to invest your money. Step 3, understanding the fees of the fund. Understand, how does the fund get paid and how do I get paid? Understand what your preferred return is, when is my return of capital, and when will my profits possibly be coming to me based on the fund strategy. Step 4, diversify. Look at the investments pooled together in an investment fund and make sure there's a diversification of assets in that fund, and also look for different strategies in private equity where you don't have exposure to one asset class. Step 5, invest and sit back and let the fund work for you. Invest in great sponsors that will generate high returns, consistent cash flows, and give you tax benefits. Now that you know that a private equity fund is a pooled fund investment, let's look at the next video of how to analyze deals that are going into private equity funds. I'm going to focus specifically on real estate deals that are going in funds. We want to make sure only good deals are going in the funds that we're considering investing in. So let's dive into analyzing commercial real estate deals like a pro. Click on the link above, click that video, and we'll get into the analysis to invest like a private equity pro.